We're getting a sort of a reversal on a lot of the excitement yesterday in cloud. Yesterday, when I covered Microsoft's earnings, one of the big things I talked about was this idea that I'm nervous about cloud. I was initially optimistic by the Microsoft results prior to them providing their forecast, right? Their forecast is what tanked the market. But I was initially concerned about Microsoft, the software sector, thinking that I would prefer to be in the chip sector, mostly because you have higher free cash flows, and in my opinion, you have higher pricing power longer term. Just given the capex requirements in essentially manufacturing and chip design than compared to software. I believe software is substantially more competitive, and I think this is very simply exemplified by Taiwan Semiconductors, which has a 92% grasp on the advanced microchip market. That is massive. This is a massive grasp that they have. Now, of course, the software sector is also getting a lot of negative attention, not just now because of the negativity coming out of the earnings call from Microsoft, which apparently was also suffering technical difficulties, which doesn't help. But also there are substantial downgrades that we're seeing from Wall Street. For example, this is prior, and then I want to cover what happened with Microsoft. Prior to the Microsoft report, we had Wall Street reports suggesting that application software companies likely face revenue downgrades ahead of Q4 earnings calls. Several percentage points of growth expectations may be shaved off going into 2023. Analysts think that average revenue growth rates could come in below 15%, while the current consensus for software is 17 to 18%. Now, I want you to keep that in mind, that the consensus is 17 to 18% software growth, because we're about to go through the Microsoft earnings report, and we're going to go through the earnings call. And while Microsoft Azure actually beat in expectations for the last quarter, their forecast was not so great. In fact, spoiler alert, their forecast for Azure was flat for the next quarter. And forecasts from Wall Street were that future cloud growth would be somewhere between 17 to 18% in aggregate. You've got consensus estimates here that I'll go ahead and show up on screen now. These are consensus estimates here, and you can see revenue growth consensus estimates calendar period here. Bill.com expecting to have grown double in 2022, but only growing by about 36 to 30% in 23-24. Now, that's not actually terrible. That's actually still pretty dang good. Intuit expected to only grow about 8% in 2023, followed by 13%. We've got ADP over here, 7 and 7. Paycom, 23-22. GoDaddy, 6-9. Shopify coming down to 20-22. Squarespace, 11 and 14. Wix, 9-14. Average consensus here, 17 to 18%. Just based on sort of this group here. We do notice, obviously, that Microsoft is not in this this list here, but coming in with essentially flat expectations for growth on Azure, not great. And that comes despite expectations that the server industry will actually do well. Downgrades coming due to, obviously, slower commercial seat adoptions or expectations for that, slower consumer growth, limited pricing leverage. That's actually interesting because you're going to see that in the Microsoft earnings call in just a moment. You're going to see limited pricing leverage, which I like to call PP. So you're going to see limited PP. Why are you going to see limited PP? Well, because you're going to see Microsoft executives talk about optimizing growth. And that's not them optimizing growth. It's their customers optimizing. And they think we're actually going to go through about a 1-year period of optimization. Now, they believe that once you optimize and after you optimize, then you will be able to get back to doing more work. However, they think we're going to go through a 1-year period of optimization. Lengthier sales cycles and slower approval timeframes are potentially likely to stall user expansion and limit pricing power, suggests a Bloomberg. The net percentage of business owners expecting the economy to improve is close to all-time lows at negative 51%, and this is likely to weigh on discretionary tech spending. Keep in mind, yesterday we were looking at Mike Wilson's Morgan Stanley report, or Mike Wilson's FUD report, I should say, from Morgan Stanley. And we talked about exactly business confidence and how potentially low that business confidence is right now, and how I actually think when business confidence is low, it's one of the best times to potentially cannibalize your competition, work harder, and do your best to keep growing and not contracting. Very important. Okay, so let's go jump into that Microsoft earnings call. So Microsoft earnings call right here. So let's take a look. I'm just going to read in my opinion, the most salient pieces. That doesn't mean I hate everything here, just doing my best here. So we've got the CEO here suggesting, as I meet with customers and partners, a few things are increasingly clear. Just as we saw customers accelerate their digital spend during the pandemic, we are now seeing them optimize that spend. That's a red flag, right? Optimizing spend is basically a euphemism for people ain't spending as much money with Microsoft, step bro. We saw new highs for Game Pass on gaming, with game streaming hours and monthly active devices at records, surpassing 200 or 120 million devices during the quarter. That's fantastic. And thanks to lower energy costs, they were actually able to increase their margins on Microsoft Cloud better than expected by 2 percentage points year over year. However, excluding the impact of an accounting estimate for useful lives, Microsoft Cloud, hold on one second here. Microsoft Cloud gross margin percentage decreased roughly 1 percentage point, driven primarily by a sales mix to Azure. So apparently a little bit of a lower pricing structure there. If you introduce a lower mix, you end up with a lower a lower margin. Keep that in mind. I think a lot of folks get confused by that. I'll just explain that really quickly. So let's say that you run a dollar store. And I love this dollar store example. I think it's the easiest to understand. You're the owner of a dollar store. When you sell the little water guns, squirt guns for $1, it only costs you 10 cents per squirt gun to buy. So you're looking at 90 cents of gross profits. $1 revenue, costs of goods sold 10 cents, 90 cents of gross profit, right? That's on little squirt guns at the dollar store, let's say. But now let's say it's a recession and people are coming in going, sorry, Charlie, yeah, bite your finger. We're not buying you a squirt gun this time. Instead, we have to spend the $1 that we have on toothpaste. And the toothpaste margins are a lot worse because when you go shopping for toothpaste, you actually have to spend 80 cents to acquire that toothpaste. Well, now your gross profit is $1 minus 80 cents or 20 cents, substantially less. And so that's an example where somebody could still spend $1 on your goods and services, on your gas, so to speak. That's an accounting phrase. But your margin went to crap. Instead of having 80 cents of gross profit, you only have 20 cents of gross profit. Terrible. Your margins got destroyed because people shifted to a product that has lower margins for you. Unfortunately, it sounds like compared to Microsoft Cloud, Azure provides a lower margin. It's quite interesting. Okay, however, they are excited about Azure with constant currency growth in the mid 30%. That's looking backward. Just wait for the forecast. All right, ready for that? Here we go. So Microsoft tells us, in our commercial business, we expect business trends that we saw at the end of December to continue into January, February, and March. While customers are more cautious in their spend, we also have the opportunity to improve our execution, given our strong position in global growth markets. In commercial bookings, with a declining expiring base and a strong prior year of comparable sales, essentially, for Azure contracts, we expect growth to be relatively flat year over year. We expect consistent execution across our core annuity sales motions, blah, blah, blah. Basically, hey, we think the company's still going to do great, and we're super excited about our company. But unfortunately, the slowdown we saw in December is going to continue in January, and everybody else is at fault. We're still performing and firing on all cylinders, but everybody's just spending less money. And unfortunately, that means instead of being excited about 30% growth for Microsoft Azure, we're actually going to be flat. And given that Bloomberg is pricing in 18 to 20%, or Wall Street potentially is pricing in 18 to 20-ish%, maybe it was 17 to 18%. Anyway, growth for cloud, and we're going to be growing at a grand total of 0. Maybe we'll even be negative. Things just ain't that great right now. Okay, that's like my super basic explanation of what Microsoft said. And so if you're wondering why in the pre-market You are seeing software companies sell down. C3 AI down about 2.75%. You've actually got Trade Desk down 2.5%, CrowdStrike down 2.5%, Microsoft down 2.4%. I mean, almost the entire software as a services business has rotated down on these Microsoft earnings. This is why, although most of the market is red here in pre-market, including the solar companies such as Enphase, SunPower, and Sunrun, all down about 4 to 4.5%. Solar Edge only down about 3%. I do expect that to continue. So if you are exposed to solar stocks, I do expect that sort of pain to continue. However, I expect there to be some opportunities to really increase your share of ownership in solar companies once we get to more pain in the real estate sector. In Azure, our per user business should continue to benefit from the Microsoft 365 suite momentum, though we expect continued moderation in the growth rate given the size of our installed base. In other words, thank you, law of large numbers. Law of large numbers means once you have so many people on your platform, it's really hard to continue growing, and ultimately you just hope to keep things stable. Oh no, but what do we have here? As I noted earlier, we exited the last quarter of 2022 with Azure growth in the mid-30s. We expect Q3 growth to potentially decelerate 4 to 5 points in constant currency. So that is, to be reiterated by over here about this potential growth that is flat year over year. So in other words, this is actually a little bit confusing. In constant, I don't know. We expect Q3 growth to this. I wonder if this could be overall. I wonder if this right here must be overall growth or suite growth, since they did say Azure they expect to be somewhere flat. But either way, you could see the information here and try to make your own deduction. In our on-premise server business, we expect revenue to decline in the low single digits. That is a revenue decline. I said that correctly. Revenue decline, low single digits. That's a decline of, again, maybe 3-4%. As demand for our hybrid solutions will be more than offset by the unfavorable foreign exchange impact. Search and advertising, excluding total acquisition costs, should be in the high single digits, roughly 7 points faster. Now, this is actually good, right? We like to hear that advertising spend is up, and you are seeing companies like Carnival Cruise Lines, for example, boost their spending substantially just to try to fill up ships. That's what they're really trying to fill up right now, is they're trying to make sure that if they are sailing, which they are sailing with the highest amount of potential paying customers. Tech as a percentage of GDP is likely to be higher going forward. However, this is a subtle way of saying, hey, look, even if we go into a recession, we think people are going to spend less money on other things relative to tech. In other words, if the rest of the world falls, I'm just going to make an extreme example here, 10% in spend, tech might only fall 5% in spend. Just as an example, right? That's roughly what they're making an argument there of. And one of the things we're looking back to are some savings for workloads. And that's, okay, this is the optimization cycle that I was talking about, where at first you optimize, you take about a year to optimize, and then you can start thinking about new projects. This is really the CEO trying to paint this vision that, hey, look, man, in life, we optimize. And sometimes you go through about a year of optimizing, and then you're back at making money again. So don't worry, the future is bright for Microsoft. I don't think it's going to take 2 years. I think it'll take 1 year of pain. So in other words, a little bit of, trying to exemplify what's going on. Microsoft is doing so, however, still painting the picture of pain. So if you're wondering why we're having some software issues, this could potentially be why. Now, I want you to also think logically for a moment about software, okay? So let's understand this for a moment. Let me give you an example. Let's say you have a team of interns, and you want everyone to make, to edit TikToks, okay? And what you're going to do is you're going to buy everyone an Adobe Cloud subscription so that way they could use Premiere, right? You want everyone on Premiere editing your TikToks, right? Let's just say as an example. And then let's say you go into a recession and you're a normal company with, 1,000 interns, right? Well, in boom time, you're like, everybody gets an Adobe Cloud subscription. Let's go, 1,000 cloud seats. Well, in a recession, most businesses say, okay, well, we're actually not going to hire new people. We're actually going to lay off, and we're going to be stuck with, let's just say, 900 people instead of 1,000. Well, immediately what you've done for Adobe is you've actually not provided cloud growth. You actually just provided cloud contraction. Because by laying off people in a recessionary time, what happens? Well, you just cut 10% of your workforce. Well, you just took away 10 seats from Adobe. But not only that, you might also say, hey, do we really need 900 seats? Or how about like 300 of y'all just borrow the other dude's login or computer when you need it, since 300 of y'all are focused on, I don't know, playing basketball more instead, or basically doing something else at the company. Let's just, in addition to laying off people, let's also optimize how many people we're paying for cloud seats for. So now all of a sudden we're going to take that down to 600. So all of a sudden you have a 40% drop in seats that are being offered to cloud subscription services. And so what do you have? Well, you have a disaster, all right? So this is a situation where it's basically, if you're growing at zero, so basically if you're a cloud provider and you could keep like revenue stable during a recession, you're actually doing good. So as much as Microsoft is sort of this negative canary in the coal mine for software services companies, 0% growth in a recessionary environment is actually good when it comes to cloud, especially in an environment where we're seeing as many tech layoffs as we are seeing. So that's something pretty important to pay attention to, my take. Now, how could this affect the chips market? It's actually a great question. Shane Huff here in our chat asked that question. How will Microsoft affect chips like Taiwan Semiconductors and AMD? Yeah, so first it's worth noting that OpenAI uses Microsoft cloud services, and most of the cloud services provided by Microsoft use hardware like NVDA chips, mostly NVIDIA chips, but also AMD chips. And obviously a reduction in the expansion in cloud makes us wonder, like, hey, isn't it possible if cloud spend is going to go down, that chip spend could go down? Absolutely. And I think a lot of that we have already seen. We've already seen a lot of that pain. Now, there were some pieces which I thought was actually very interesting. There were some pieces that I was reading about yesterday. Let me see if I can find it here. There were some pieces about how we could potentially actually see an acceleration in Microsoft, or sorry, in chip spend as the demand for higher quality servers accelerates the refresh cycle for chip spend. So keep that in mind. As these cloud companies want to get back to growth, they have to figure out, okay, well how do we potentially differentiate ourselves from our competitors? Well, unfortunately, the way you differentiate yourself from your competitors is you try to prove that your product is a better product or a faster product or a more capable product. And unfortunately, you do that by refreshing the chipsets that you have in your server industry or your server division. So while obviously we expect the chip sector to slow down, there is at least some enthusiasm that as cloud slows down, companies that suffer from those cloud slowdowns are going to be very incentivized to try to get back to growth as quickly as possible, potentially double down on their investments into chips to make that a potential reality. That's just an idea. I think ultimately everything slows down when we go into a recession. Hardware certainly being one of those sectors that is expected to slow down. And a lot of that, fortunately, seems to have been priced in already. Obviously, no guarantees on that, but that's quite interesting. In fact, I have a piece here. Let me see. I'll read this out because I think the question is very good. This isn't exactly the one that I was looking for, but this one could be interesting. It talks about Taiwan Semiconductors and Samsung sales. Taiwan Semiconductors and Samsung and other foundries could expect revenue of their advanced packaging business, key to producing chiplet-based semiconductors, to double by 2025 and become a major growth structure. Chiplet structures are likely to become increasingly popular in laptops following the introduction of AMD's first chiplet-based laptop semiconductor. That's quite interesting. I think this has to do with the 5 nanometer chipsets. I'm actually not super familiar with chiplets, and I can't find that piece right now, but I'm going to try to Google it really quick. Server chips, shorter refresh cycle. That's what you kind of want to look for, is that potential server refresh cycle. I will do one more look here. But I'm generally a big fan of being the pickaxe seller versus investing in the gold. Now, that can come with risks, obviously, as well, because it does still rely on the gold performing very well.